Hey everybody, welcome back. Today we're analyzing Exxon Mobile, an oil stock. So this might be a little bit difficult to analyze. It is a commodity company. They drill for oil basically. They're an oil producer. One of the largest in the world, actually probably the largest in the world. Basically in the energy sector, uh, doing commodities. So I would expect it to be cyclical because commodities tend to be cyclical. Here's a 5-year chart on TradingView. Goes from 80 bucks. Then when we had that oil shock and oil went negative, it got all the way down to $32 a share, and now it's back up to $113 a share. The market cap is $450 billion, and its price to earnings ratio right now is only 13, so seems pretty decent for their earnings right now. And let's actually take a closer look at the financials here. And let me zoom in to this a little bit. Here is the revenue, and it's really all over the place. The reason why is because it's heavily dependent on oil prices. And then we have their income as well. Their income, they had negative income here. Otherwise, it's been positive the whole way through. So I guess that's good to see. Their only negative year was 2020 when oil just fell out of bed. Let's check the balance sheet here. 16 billion in net debt. It's not bad at all. They actually have a super good balance sheet. Check their cash flow. Cash flow is going to follow pretty close to their earnings. 36, 58, 33, and 23, 55, 36. I mean, it's close, but it's not exactly the same. Let's check the stats and see what their net margins have been looking like. We've got return on invested capital right here. It's between about 15 and 7, excluding these two outliers. So it's not great return on invested capital, but it's not terrible either. And then their net margin is basically very correlated with the return on invested capital. Net margin, I could say probably hovering around like 8 to 10% on average. And I want to check out this chart of crude oil. All right, so I have this as a 25-year chart. And right now we're at oil. Oil is at $80 a share, and Exxon Mobil is going to be very dependent on the oil price. And you can see what the oil price tends to do. It's up and down, really. It is up and down, and you can't predict it for the most part. Right here, there's a recession, it dropped off a cliff. Right here, there's a recession, it dropped off a cliff. But like right here, we didn't really have a recession, but for some reason, it just decided to take a nosedive. So yeah, really got to watch out for that. One good thing I could say is maybe a lot of times it wouldn't be correlated with the overall market, so that could be a positive if you pair it with some other assets. Right now we're at $80 a share, and there is lots of times where it is trading at like $60 a share or even below that. So we might be kind of elevated at this point. Let me get out of here. And I just used the estimates from Yahoo Finance for their earnings per share for this year and next year, and for the revenue estimate as well. They expect revenue to grow by about 4% into 2025. And I put that into a DCF model. So this is going to be tough to use. Let me zoom here. So I use the estimates. The growth estimate was like 5% for earnings. Yeah, it's really tough because it's so dependent on oil prices. And so I don't even know if this growth is accurate. I think $80 for oil is actually elevated, so I don't think that this growth is realistic. I really think it's actually going to be negative for a year or two, and then probably positive for a year or two, and then maybe negative, because it's very cyclical, up and down. It's not consistent like this at all. So I would maybe expect maybe like a 2% growth on average just to keep up with inflation at this point. And then maybe the the revenue growth as well probably just keeps up with inflation at 2%. And then they were between like a 8 and 10% margin on average. So I would do like a 9% margin overall. And then exit multiple of 15. Right now they're trading at 12. I think it's fair to do an exit multiple of 15, and then I have a discount rate of 10% because I want a 10% return on my stocks. And using this, we could say that it's trading at, it's like pretty close to its fair value. And even with the revenue one, it's trading very close to its fair value. If we had an exit multiple of 12, like where it's trading at right now, then the fair share price goes way down, because exit multiple has quite a bit to do with the fair value. But yeah, if we did 15 and then maybe a discount rate of like 8%, 8% we're in the green. So I'd say if you bought it today, you'd be expecting like an 8% return moving forward, like overall. Obviously, it's really, really hard to predict because oil is just up and down and sideways, and nobody knows where it's going to go. But with it being a cyclical business and being unpredictable like it is, it doesn't quite follow the market as closely as a lot of other stocks. So it might be good as like a defensive position where if a lot of your other stocks are going down, then this one might be going up, and then you'll be able to use this to kind of rebalance the rest of your positions. So actually, from that standpoint, it could be a really good company to hold. And yeah, I think that's a good analysis on Exxon Mobil. I hope you guys enjoyed. If you did, hit that like button and leave a comment in the comment section if you have any questions, because um, I also leave this spreadsheet for you guys to try yourself. If you guys think Exxon Mobil is going to do different numbers than this, then you can plug them in yourself. And otherwise, I'll see you in the next one. Peace.